More New Zealand companies have become takeover targets. How to know if you're getting a good deal?
You need to be looking at where am I now, where is the company now, and what value am I getting out of it?
And since we're in a recession, how can you identify stocks that may be resistant to it?
So just be very, very careful that the company in a slowing economy has not overcommitted themselves in the good times.
It's Monday, the 31st of July, and you're watching Markets with Madison. Already this year, we've seen a handful of takeover offers coming after New Zealand companies. EROAD and Metro Glass have both declined offers from competitors and private players. They've become targets after Pushpay was bought out by private equity just a few months ago. This looks to me like the start of a takeover trend. So who could be next? I sat down with a leading M&A lawyer, Mark Stuart, to find out. Mark, thank you so much for your time. Good to see you.
Good to see you too.
Is this a takeover trend?
Well, yes, it could be actually. I think if you look at the NZX, we've had a number of takeovers launched in the last few months, and also some successful ones earlier on in the year. But whether it's a trend or not, if you look at the NZX, it's not the biggest exchange in the world, and if you look at it in terms of numbers of companies listed on the NZX versus rest of the companies in New Zealand. If you say, well, one takeover on New Zealand, you might be having sort of 50 other M&A activity happening in the rest of the market. But I think from an NZX perspective, yes, look, a bit of a trend developing.
What's activity like in the private market? Is it as busy as what we're seeing publicly?
I think if you look at it, the activity in the private market has slowed down from the heights of 2021 and 2022, which were, I think everyone will acknowledge, was sort of knock it out of the park years. But where we're sort of getting to now is probably a more normal state, getting back into how things were in sort of 2019 in terms of deal flows. But we are seeing renewed activity in the market, I think with reduced prices and reduced expectations from sellers. There's a little bit more activity starting to take place. So we're pretty confident of what we're going to be seeing for M&A activity in the next 12 months.
The public offers that we have seen, namely EROAD, Metro Glass and Pushpay, they've all come from different ends of the market, some from private equity, some from personal players in the private market. But one thing that is quite similar is that all of the initial prices were declined. What do you make of the pricing that's being launched, and is it opportunistic?
Look, I think there's got to be a starting point somewhere, and I think bidders now know when they're putting in an offer, it's pretty unlikely that your first offer is going to be accepted. We've seen it on a number of occasions where boards are actually being pretty robust in terms of getting advice as to what the company's worth and actually making a call on saying what you're offering is not enough to actually let me open the books for you to have a look at the company. So, please go away, reconsider your offer, and then we might talk. And I think that's what we've seen play out, especially in the as you say, the EROAD and the Metro Glass at the moment, where the boards have actually said, look, it's not enough for us to let you go any further.
Is that a strategy perhaps from the bidders to just come in with something cheap and see where it lands?
I think that might be part of it, and whether or not they put their best offer forward to begin with, it's not necessarily a common negotiating strategy. So look, I think the expectation, I think, is that they probably thought that would be the initial response.
You mentioned just earlier that boards are really confident in the long-term value of their companies. I guess that's a positive for the market, right? What do you think has contributed to that high confidence in their strategies?
I'm not sure if it's a confidence. It's I think boards really taking their role seriously and making sure that they extract the most for shareholders. So they take advice, whenever you get an offer like that, they'll go off and get advice essentially about the forward prospects and really have a robust discussion in the board about, is this enough to actually let us, someone come in and have a look at the transaction and the company with a view to doing a proper deal down the track. So I think it's boards taking shareholder value and wanting to do the best for shareholders very seriously.
New Zealand company valuations have come off a bit of a peak this year. Should we read into anything about the timing of these offers being launched and perhaps our companies being cheap?
I think valuations have definitely come down, but I think any bidder that's coming in will see that there's opportunity there, but equally they have to work out, well, what am I going to do with the company going forward? Where am I going to see value that I might be able to add to this business? Is it, I can roll it up with something I've already got and create synergy benefits there, or if I got another company in the group, we can grow with that entity. So I think it's balancing those two things, saying, yes, I'm not having to pay as much as I may have had to pay 6-12 months ago, but also I've still got to be looking at where am I going to take it forward? How am I going to take the business forward? And I think that's a key point for it.
Whenever you act for clients in these sort of situations, what are they typically looking for in companies that they're buying, specifically New Zealand companies? What do they like about them?
I think a lot of what they like is, a lot of the time, is around the technology that the companies have and the ability to take that to a broader market and bring in the expertise that they may have in other places in the world to actually grow the entire business. Because I think that's often what they're doing. It's the growth strategy of how are we going to grow this business and essentially make more money for the bidder once they've completed the acquisition. They feel that they can do better with the business than it currently is.
How do you think that investors should feel about a company being taken over that they like being invested in? Should they be optimistic that it could then grow in private hands and eventually come back better? Or should they be annoyed that it's leaving their portfolio?
Well, I think as long as you're getting fair value for your shares, and often when there's takeover activity, you receive a premium for often a significant premium based on the most recent price. But if you take something like EROAD, where the price has dropped, I think from 12, 18 months ago, it was sitting around the $5 mark. And investors who have invested back then might be going, well, look, if I'm being offered $1.30 or whatever it is now, I'm actually not in a brilliant position. But I don't think that's the kind of thinking you need to be taking. You need to be looking at, where am I now? Where is the company now? And what value am I getting out of it from the offer that's coming? And if I get a good enough premium, I can take that money, I can go and invest in other companies.
Who could be next, Mark? What do you know that we don't know?
Look, I don't think I can say too much about what might or might not be happening in the market, but probably the way to think of it is that a lot of the talk that goes on and approaches that are made to companies, to listed companies, doesn't actually get made public. As long as the approach is kept confidential and confidentiality is maintained, you may never hear that it's going on. It's not until either party wants to make things public, either to put pressure on the board or the board wants to put pressure on the bidder, that you often get announcements made. So look, there could well be things in the pipeline. I'm sure there are. I don't want to comment on any specifics.
I wouldn't expect you to anyway. But just in terms of, perhaps you could put a ratio on it, the amount that happens in the private market that investors don't see versus what comes out, is it 90 to 10, 80 to 20?
I would say for every one listed company transaction, there's probably 50 going on in the private market. If you think about that, there's sort of 2 on the go at the moment, potentially others. But there are multiple transactions happening in the private market that you just never hear about. The only time you might hear about it if people want to actually proactively put an announcement out, or if it filters through the OIO regulations, if it needs approval, and often it comes out through that one. And you'll see things in the media where people are making comment long after a transaction's actually settled. So I would say it's something like maybe 1 to 50.
Well, I'm sure there's plenty more to come, so I'm sure we'll keep chatting, Mark. I appreciate your time.
Good, thank you.
It's no secret that we are in a recession, and companies like Mainfreight and Ryman Healthcare have all recently sounded warnings over the downturn. So with earnings slowing up, what stocks should you look to for growth? Greg Fleming from Salt Funds has a list, and he's here to share it. Hey Greg, thanks for being here.
Hi, thanks Madison.
We're only in a technical recession, and the US isn't actually in one. So why should we be looking for recession-resistant stocks now?
So this recession has been predicted for probably about 18 months already. The US Federal Reserve began tightening interest rates with the express intention of inducing a cool down last May. They've kept going until tonight. I think we're going to get another tightening from the Fed. Similarly, RBNZ here has been tightening. Now, normally the objective of doing this is to induce an economic cooling to the point that demand softens, that prices are able to plateau or at least to start to fall. Complicating factors are manifold this time. One of them's been the amount of fiscal spending on the other side. We've had monetary policy tight, but on the other hand, governments have been granting a lot of cost of living adjustments, giving people more cash. Strong political arguments for that, but the right hand is taking away what the left hand is giving and vice versa. So that's the background, really, and it means that it's difficult to call the precise beginning point of a cyclical slowdown. The market's divided into stocks broadly that are cyclical or defensive. The cyclical ones boom in times where expansion is about to start or is in full swing. Defensives when the expansion is cooling or has already cooled and an ice age has set in. And the recession-resilient stocks, don't say recession-proof, recession-resilient is best, are the ones that you would look to at the best moments in the cycle when their only way is down. So even though there's been no big global Northern Hemisphere recession this year, there's still enough lead time in that tightening cycle to expect something like that in 2024. So a good time to get positioned in advance.
Is now also a good time to pick them because cyclical stocks, namely tech, have kind of had their best case scenario play out already, right? So are you of the view that that just can't really continue?
Yeah, I think that the tech has got its own story in that there's a whole utilities style tech. Now, I'll unpack that. Utilities is traditionally a good defensive sector, along with consumer staples, healthcare, and telecoms. Those were the four sectors where you'd go to in recessionary or cool growth times. Certain tech companies have entered that utilities space because in a funny way, they behave like utilities. They've got very, very sticky customer base. They are providing subscription services, which are billed every single month off the credit card. People are very reliant on them. You could argue that using, say, Microsoft Office is a bit like using a particular electricity provider. If you suddenly have a pricing problem, you don't switch provider immediately. There are a whole lot of reasons not to. So sticky customer base. And so many tech stocks are behaving more like utilities and ironically being defensive as well as being cyclical, which is probably why they've done so well. They're showing features of both economic cycle suitability. If you are happy with concentrating a portfolio in tech, there's a good reason to stay there. However, they are priced for perfection at the moment. We have earnings coming through, which, is probably better than had been expected earlier this year. But nevertheless, there seems to be scope for disappointment there. So tech stocks are still very, very richly valued. Longer term, they're probably aligned with emerging technologies like AI, the ones that are doing that great. But others still too are facing competition and not so much price competition, but product type competition. New generations of social media, those kind of things. And they can leave a big tech company stranded unless it's very agile.
Now, you touched on one of those sort of core fundamentals to look for in a stock there, pricing power. But what else should we look for to identify something as recession resistant?
Yes, pricing power, and that can lead to stable revenues. So a stability and predictability of earnings, not kind of wild quarterly swings in earnings. Now, of course, the thing about that is that when you're in a better economic period, those stocks can get left behind. People see them as being a bit dreary or a bit predictable, and they want something with a bit more punch. And they can end up being squeezed out of portfolios and be at very low weightings just at the point that the investor would need them in there. So there's the pricing power and the predictability and stability of revenues. I think another thing, as I'd say, is a good global reach in consumers. So you're not dependent on a particular country or region's economy, but rather if one part of the world accelerates while the other is falling, you have the upside coming through. So exported sales of their products is a big help.
So what should someone look to avoid then?
Okay, probably the converse. You'd look to avoid a company whose sales were one country only or one product only. So diversified product range is really helpful within a company. They can pivot and they can promote one product over another depending on receptivity in the market. So it's a limitation of customer base or of product range that is a big red flag. Also, probably excessive debt is a red flag as well, because when your revenues are volatile or are pushed down by the economic cycle, you don't want to be servicing debt at high interest rates during that period. And that extends to companies that have taken on debt to make acquisitions in the good times. That can often look very, very sexy to make revenues accrete to the master company when it buys another company. But when conditions turn, they still have the costs that are fixed in the acquired company that they have to be paying. And unfortunately, too often, they end up slashing the provisions that the target company was offering. They can lose market share as a result and be back where they started. So just be very, very careful that the company in a slowing economy has not overcommitted themselves in the good times.
Yeah, we've certainly seen that. What would you consider to be excessive debt? Obviously, it differs between sectors, so real estate is more indebted, for example. So how should an investor determine what is excessive for any certain sector?
Yeah, it's a good question. I think that real estate kind of justifies its debt, as does infrastructure, because the cash flows are very long duration in real estate and particularly infrastructure. So no surprise that a company might have needed to take on debt because they're building capital assets that are real and expensive and require maintenance costs, all that kind of thing. It's more companies that have used that debt for promotion or for new market entry and have sort of burned through the debt that they borrowed on spec, on the hope that revenues would then pick up. So also look at the profiles of the debt and the way it's structured in the company. I think that's key. Some analysts have talked about kind of maturity walls that various companies are going to hit, where they'll have to roll over. And it's not unlike the fixed-term mortgage residential issue. It's just written on a corporate level. Some companies issued a lot of debt when interest rates were exceedingly low for as long a term as they could possibly get away with. And they're actually fine for another 6 or 7 years globally. But others may be rolled over a bit too quickly, and they might be looking at maturity walls in, say, 18 months to 24 months from now. So checking the profile of maturing debt is key, because no one wants to invest in a company that then is going to need to refinance and possibly raise equity to cover that refinancing.
Okay, so all of that, red flags. What are the sectors and companies that you like in a downturn, Greg?
You get companies out there, particularly in healthcare, that have been neglected. And I think in New Zealand, we've got to be careful when we talk about healthcare. It's not just, say, the retirement sector or things that are property healthcare or care. It's not just hospital operators. It's a very, very diverse industry globally, not only pharmaceuticals, but you've got the insurers, you've got companies that are very focused in medical device technologies, and those are ones that we certainly favour. The reliable orders that flow through from the global health system for particular devices and technologies tend to have stable cash flows. Once they've established a big sales footprint globally and a quality and a reliability reputation, those companies tend to be very good through recessionary periods. And there are certain non-discretionary items in any hospital's spending budget that will never be switched off or never scaled back just because of patient need. So I'd say that within healthcare. I think if you went out into staples, similarly, there are simple things that people might not think of, like the manufacturers of Nurofen, for example, or of Dettol, or of a wide variety of cleaning products and personal hygiene products. Those companies have been building up customer bases in emerging markets as well. So you've got a huge diversification. If there's a developed world recession, but not an emerging markets recession, you've got sales growth there. But generally, people do scale back those expenditures last. They might perhaps go to cheaper brands or OEM kind of brands, but the big diversified consumer products companies like Reckitt Benckiser, Johnson & Johnson, Unilever, they have all price points in their product ranges. So they don't necessarily suffer if people give up on the top priced brands.
And just want to be really clear here that the upside that you're getting at here is on a capital gain basis, right? You think that their earnings are more resilient and that will translate through to a higher share price, correct?
Yeah, that's exactly right. It's the compounding of those earnings is the approach that we're looking for over time. And that's distinct from companies that just have patches or sporadic bursts of good earnings news. So you can grow earnings at a somewhat lower rate than the market as long as you grow them consistently. Those are the kind of stocks that are the best in a slowing economic environment, for sure. That means probably that you don't get quite the same quarterly news cycle driven stock price movements either. And these stocks can stay cheap for a while, or they can get expensive and stay expensive for a while. They're not always the ones that move the most on the day that the market moves the most. And actually, in that way, they baffle the volatility of the overall portfolio.
To sum it up then, look long term, you think?
Yeah, I think it's look long term. I think it's also if something or a sector or company hasn't participated in a boom phase, that doesn't mean there's something wrong with the sector or company. It may mean that they've just been overlooked due to the greater attractiveness of another sector or company. And the most robust companies out there, they don't care. They don't care that their share price hasn't gone through the roof because they kind of don't need to care. They're not incentivized, the management, by pushing the share price up in any one financial year. Rather, they build brand recognition and quality over decades sometimes. And the share price, if it reflects that ultimately, that's kind of a great thing and management won't reject it. But it's not their first objective in any given financial year. And those are the ones that can get overlooked in the market and where value is still omnipresent, even in an expensive global equity market.
The poor neglected quality stocks. Thanks so much for your time, Greg.
Pleasure. Thank you too, Madison.
All right, well, US earnings season is still ongoing. This week we'll get reports from Amazon, Samsung, MasterCard, McDonald's, Nestle and L'Oreal. New Zealand's earnings season kicks off mid-August, which is coming up soon. And that means that most of our big companies are now officially in a blackout period. Expect it to be a pretty quiet few weeks on our market, given that. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald's show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.